Just wanted to point out the information we provide today is of a general advice. If you do want some more information, please seek some professional advice.
Welcome to the latest episode of the Retirement Living Your Way podcast, where we have real conversations with Troy Theobald and the team from RFS Advice. My name's Greg Black, and joining me in the studio today we have Troy Theobald. How are you, Troy?
Very excited for this one.
Very excited. Well, you should be. It's right up your alley. Which is fantastic. And we've actually got Josh Nixon back. And this is the second part of the two-part series. So for those that listened to the first one around investment fundamentals, we had a look at that sort of conservative end of the market and had a look at the underlying investments, not digging into portfolio construction, rather having a look at some of the characteristics and, I guess, things that we think about. And for this part, we really want to move up the curve a little bit and move more into the growth and specialist type managers. And as we started last time, I've got a few rapid-fire questions. So I enjoy it. So I just thought, unfortunately, you two are just going to have to answer.
You found some more, did you?
I did find some more.
Of course you did.
Exactly. Of course I did. So again, I don't mind. And I know you boys think alike, which is the result of working together and doing what you do for a very long period of time, which is absolutely fantastic. So let's start. International shares, global opportunity, or currency headache?
Has to be global opportunity.
Yes, definitely.
Thematic funds, future winners, or investment hype?
Can be both.
Yes, I agree.
Agree? Okay. We're going to have anywhere you don't agree here.
Maybe. I don't know the questions.
Crypto, good or bad, or indifferent?
I don't know. Greg, you can tell me how much this pen here is worth, and I think we'll figure it out.
Yeah, it depends on the demand on that, doesn't it?
Yeah.
Anyway, we're not going to touch that. I just thought that was funny because I just thought it's one that we do hear a lot about. It's certainly not in our will.
We don't hear people walking in the door telling us they don't need any of us and they make a lot of money. So that certainly hasn't happened in the last 12 months. But 12 months ago, they were very, very vocal. And we would just ask them, how do you value it?
Yeah. Yep. Okay, I keep moving on. What have we got here? Index funds, low cost, common sense, or blindly buying the market?
Low cost, common sense.
Yeah, I'd agree.
You agree?
That's their some of the underperforming managers out there.
Yep.
Probably putting out the other. You are buying things that are up, but it's generally good, consistent, larger companies that.
Okay, well, let's pick up that theme towards the end, especially with what we've had over the last sort of 12 to 18 months. What about active funds? Genuine skill or expensive hope? Ooh, this is controversial.
It can be both at the moment, probably more so in the last couple of years, I would say.
I'm going to have to agree because there is definitely managers we've met that have some amazing insights and skills. Few of them, it's the rocket science about buying what's going to go up. Majority, it's the cleverness with controls and downside. And we've got one coming, presenting to office to our clients, someone, a doctor of amazing abilities the other day, and he left, and Josh and I are fist pumping, going, "Wow, he's the real deal."
Yeah.
And what was impressive was their methods and their methodology around risk and risk reduction.
Yes,
that's what was impressive.
Yep. No, that's fair. Private equity, long-term opportunity, or too hard to value?
Private what?
Yeah.
Where's your money going? It's really complex. I can't tell you. Where's the door? Can I run?
Yep. Yep. Commercial property, reliable income, or tenant risk?
Also has an element to both.
Yeah.
Yep.
I think it's changing nature a little. Definitely businesses buying it for themselves, so it's got that good long-term scenario.
Yep.
Others, the income yield can be good, but the income tends to be on the Gold Coast area probably not great now because people are paying overs.
Yep. We've obviously seen a lot of news about this one over the last few months. Residential property, proven wealth builder or emotional favourite?
Oh, both.
Both.
Depends when you bought it.
Yeah, big fan of people buying their best principal place of residency. Very big caveat, that they can afford.
Yes.
You need to be able to pay this damn thing off. We don't want to be sitting here in 20 years' time going, I still owe the same, and didn't work for you.
And maths is maths, as you've told.
Yeah, maths is maths. It doesn't matter. It's what you earn. You pay the tax man. You pay every other bill, and what's left over is what you get to pay off the debt. And if that doesn't pay it down, you've got a problem.
Yep. And last, which is a bit different to what we tend to do, but I'm just interested in your thoughts, off the plan property, smart entry point or settlement risk?
That's an interesting one. So if you look out our window at Bundle there, we can see all the cranes going up.
Yes.
So I do have a specific scenario that helped one of our clients with. They had off the plan, so they sold their principal place. They were really looking forward to going to the new flashy building. They had the brochure. They had told us everything that it was going to be, and ended up having to live in their caravan for up to 8 months because things got delayed. So whilst it can be positive in the sense it's new, it might have good facilities and looks great, just be cautious on some of the time frames and what you might do
and
in between.
I think the budget is going to make that worse, because every glossy brochure is going to say, look, you got to buy everything new, but you only make money if you sell it at a gain. So who's buying your old one?
Correct.
If everyone's suddenly buying new. I don't know how that plays out, and that's going to wait and see how that plays out.
Yep. Okay, so let's jump into it then. And obviously what we want to try and do today is, I guess, get listeners to think about the role each investment plays within their portfolio. And we did that in that sort of conservative, more income end bucket, and we spoke about cash and fixed interest and the like. If we start off on international funds, how essential is it to have international exposure in a portfolio? And sorry, and the second part of that is different ways to hold that international exposure, whether it's direct or through a managed.
Yeah, so we tend to equal weight Australian international shares in our portfolio, because Australian shares haven't given as much growth but have given more income and more franking credit, so that they're satisfying. You've got to get income in a portfolio, you have to have growth. We tend to try to get somewhere between that even match between the two over time, so that we're not too much issue with ongoing income tax, not too much issue with capital gains tax. So definitely international shares have provided that longer term growth and gain, but you've got to have a methodology how you're going to deal with their extra volatility.
Right.
And certainly if you think about the difference between Australian shares and international, Australia is domestic companies only. International unlocks the rest of the globe. So there's a lot of big monopolies, a lot of new ideas and things out there. So it does present a really good opportunity, but it's got to be in a risk-adjusted manner, or to our earlier point on understanding the investments that you are owning there.
Yeah, and I guess if you have a look at a lot of the AI, the growth through AI, like you just...
You mean the real AI overseas, and if you buy a tech ETF in Australia, I think what's in there?
So the top two are realestate.com and car sales.
And I would think they make a lot of their money from marketing and advertising, and there'd be a higher spend when they're doing well and consumer spending was low, it would drop, as opposed to a clever chip or something AI related. Yeah. So just make sure if you're picking a theme, look under the bonnet, true for label. And
just on that if you're looking at international, there's obviously the world's a big place. You've obviously got, there's the US market, there's, parts of Europe, UK, and that's also, people need to be aware of that as well, don't they? There's different levels of risk that they're taking on.
Oh, there's different to investing in a South Korean something or other than something like in, a NASDAQ or something that's growing, or the Dow Jones with the biggest companies in the world pretty much. So there is a vast difference in risk and volatility.
Yeah, and then currency, you've got currency overlays as well. Is that something
currency
that
is interesting.
Do you give that a lot of thought, or you can manage that?
You can invest in hedged and unhedged vehicles in most.
Yes.
Hedging, it's an interesting one. We have our own internal policy for the models that we run, and we have an on watch, and when we would move more hedging, that's a personal house view.
Yes.
That we have.
But it is you're still factoring that in. It's still part of the decision making process.
So the worst thing you want to have, and if you go all the way back to 2000, was when one fund there was saying it was the best fund and had this massive return, and our currency had the opposite return and people made nothing. That was a very good learning. People should have learnt that have been around for a long time investing, that currency matters. And until that point, nothing in our industry bothered with that. And after that, everyone had a current hedged or unhedged version.
Yes. Yeah. Yeah, no, that's interesting. So just moving on to the next, I'm just conscious of time because I know you two guys will just keep talking if I don't move it along. Thematic funds. Josh, do you want to just sort of give our listeners a bit of an overview of what they are?
Sure. So a thematic fund is looking at an identifiable area or theme. So instead of being broadly international, it may focus on one sort of theme, a couple of options out there in the marketplace that might be a gaming theme or an oil theme or a defense theme. And the first thing I'd probably call out is just be mindful of what amount of capital you may want to allocate to a certain thematic. So if we look at it for clients, we tend to have a core holding, meaning majority of the funds are set out a certain way. And then if we do believe, after speaking with the client, that a thematic may be appropriate, then it's typically what we call a satellite or a smaller approach to the side. And yeah, a couple of things, they can be quite narrow, and one of the most important, or one of the things that has been shed to light recently, is around timing risk. So I'll use the oil one as an example. When people have gone to the petrol stations this year and have seen diesel at over $3, in that instance, in theory, the oil thematic would do really well. But prior to that, it may not have been too interesting. So it just shows the importance of the timing and the hype that can be around it as well.
Because I think that's a challenge, isn't it? What's long-term theme and what's short-term, excitement?
Absolutely. And it certainly is, I know we're talking about the growth side of it, but it can be very high growth and very volatile, because if there may be news or headlines which paints this thematic in a bad light, then you may see a high volume of people wanting to exit that position. And if you're not on the ball, then could be left in a difficult situation.
These are going to swing, and the more thematic. I was just looking at one there. That's what I was looking at there. There's an armour one with what's going on in the world, and it hadn't done much, and then it seems to be up 25% in a very short period of time. Yeah. But you could have bought it a little while ago, and it probably dropped 30% in a very quick period of time. You could buy a Bitcoin one and be down 50%. You could have bought it 2 years ago, and you might be up 100. Yes. These things move around, so you can have thematics around lots of different things, but you want to know what they're investing in, and then it could be gold. There's all sorts of different ones. If you have too many of these things, invariably they're not going to work. Yep. Because you're thinking you're the guru. I can pick the 5 things in the world. They're going to all do well. They're probably all. How do they actually work with each other? Like by nature, are you actually buying one thing when it goes down, the other goes up? Okay. Well, we ended up back at middle ground. We could have bought boring and had the same outcome with a lot less risk. So it's just how you use those in the portfolio.
So just on that, like, you've been doing this for a very long time, because it's been over 25 years now, I think.
Same age, continue.
I know, but in your experience, retirees, how much volatility can they really handle in their portfolio? I know that's a very hard thing to answer as a general rule, but there must be a rough idea. Like
when they put an amount in, and if it's in the early period and they've seen that, say they had $1 million.
Yes.
Simple. If that million dropped to 950, they'd be like, oh. If that million grew to 1.3 and then dropped 200 grand, they're probably less worried.
Yes.
So timing and time in the market can vary, so it's hard to put a percentage amount in there. We know the clients from our perspective, because we know. So we know the ones to call when markets move, because it's going to bother them more. Now, we can tell them and the reasons and the risk and all that, but risk and return is still a trade-off in regards to that. We'll have other clients that'll be ringing us going, how much worse can it get? I've got it ready. I'm piling the cash up ready to go in. So same investments, 2 different phone calls.
Yeah, amazing.
It's some people will understand that these thematics and things, you add them in when it's doom and gloom, there's blood in the water. Yeah. That's the time you want to buy these things.
Yeah. And you deal with...
But you got to take the profit at a point.
Yeah, I was going to... Because you deal with a lot of high net worth clients.
Yeah.
Do you find that those that have got, a lot of wealth...
They're happy to enter, hard for us to pry their fingers off and let us take some profit.
Yeah. That's what I was just, and then I was also thinking, do they become more conservative once they get to a certain point? Like, do you find that...
I think the absolute opposite. I think there is far too many high net worth clients getting sold private equity, things that could lose capital,
Yes.
as in lose the capital they've invested, and they are not taking or paying enough attention because they're getting told, you're high net worth, you should have these.
Wow.
You're sophisticated, you're wholesale, you should have your money in these.
Yeah, but half they haven't made their wealth, most of them haven't made their wealth from building
Investing in
investment
those
portfolios.
things.
No,
No.
they've done it, they've been plumber, they've had this, they've had that, whatever,
Correct.
Medicos, whatever it might be. So it's, wow.
Whereas our clients, good, consistent, if we can get good, consistent return compounding, our clients have made the money out of what we've invested for them because they want that consistency. Now, we'll put percentages into some of these others, but not betting the farm. And way too many high net worth families and households have things that I just don't think they should be anywhere near it.
And as people age, as they get a bit older and their interest drops a little, you know what I mean?
I don't think it's an age.
We won't have,
I don't like seeing anyone lose any money or having it locked up no matter how old they are.
Yeah.
So.
Yep. No,
And I think as well, Greg, just on that point, for retirees, oftentimes people they may not realise that they're probably only 50% invested in what we'd call growth assets. So yes, the portfolio is going to move up and down. However, they're not 100% invested in the share market, which in theory helps reduce some of those ups and downs periods as well.
Yep, no, good point. And look, I said I've got to keep you guys on track. I've got to keep myself on track here. Otherwise, we will be pushing in time.
Oliver will be keeping on time because I didn't press the button.
No, that's okay. I'll move on quickly, Oliver. Index funds.
Love them, low cost, covers the basics.
And a lot more.
Do their job.
Yes.
Yeah.
So just, Josh, what are they? Just so people that aren't familiar.
Index funds is you own a little bit of everything. It will track an index. So for the Australian All Ords, if you buy an index that is the All Ordinaries, that's what you own, plain and simple.
Yep.
In a more complex high net worth, you probably don't have as much income producing, you don't have as much franking credit, so the granular bit.
I knew you were going to go there. That's why I could see.
So we will use them, but only for a portion of the portfolio. I wouldn't go.
They do have a place?
They have a place for a portion, absolutely. Yes. We do use them in a lot of asset sectors to get that broad asset return coverage.
Yes. Okay, and then what about the smart beta funds?
Big fan of those. They are probably ending careers of lots of professionals in financial services. They are bringing fees down that we love. We love lowest cost, quality product we can deliver to our clients. We use our buying power to force institutions to give us institutional rates and pass 100% of those savings to the clients. We've been on that journey for more than a decade now. Smart beta just helps us do those even more. So we like.
So what are they doing?
So picture, we like factors. So there'll be a smart beta we like quality, boring things, the biggest boring quality companies that are consistent. Get rid of the ones with too much debt. Get rid of ones with no earnings that are really there with the frothy, and just buy what's left.
Yep.
We can get access. We like that. That's our approach.
Yep.
We like that.
Yes.
That resonates with us. If clients want the other frothy, we'll go and pick the thematic. But we'll pick the one we want, not the one others want, and let the client enter and exit based on that terms.
Yes.
And I'll just add to that, in certain smart beta approaches, when we look at the data or the performance, one of the things that I like the most is we're not having those please explain conversations with managers. If they have a tight framework or methodology that they adopt, then the variance to the market in general isn't often as large. So a client's not going to walk into our door and say, please explain why is this fund 10 or 15% under or over the market. It's just about stacking those little wins over time, and most clients are pretty happy with that.
Yeah. And you do like going into the detail.
Yeah, and that is that. Well, I mentioned before that upside downside capture. In simple terms, if a market went up 10%, they get 130% of the up, so they're good amount of the up. But what do we get on the down? Yeah. We like managers to have less down than the market. We don't want 150% of the down, meaning if the market dropped 10, they're down 15.
Yes.
And a lot of the higher growth strategies, the downside is not palatable to a lot of clients.
Yeah.
A lot of managers will walk in and tell us about the good stories, but I think Troy and I, one of the first few questions, what's the downside capture? What's your sell discipline?
Yeah, and the one the other day that was impressive said, you asked me about any company in the world. And we did. We didn't pick the sexy one. We picked some sexy, nice ones and went, why would anyone buy that for this reason? And they ran through these different scenarios and what they do with that, and just very good answers, as opposed to other managers that walk in the door and here's my best 3 stock picks.
Because I was going to ask about that. How do you determine, and has the market changed as far as the fundamentals of the market? So, you go back 10, 15 years ago, it was all about the manager.
Yeah.
There were certain managers out there that were actually like rock stars.
Yes.
If I look at it today, there's obviously it's morphing, isn't it?
Well, it is that single manager risk. There's no doubt there's still some out there.
Yeah, absolutely.
We still use some active managers out there, and you do need to do your homework and look at those scenarios. But when you meet those people, it's a philosophy. It's not a gut feel. They generally, the theme, they don't come in talking about their best wins and their best this and their best that. Yeah, we got those calls right, we got those wrong, we could have done that better. There's always self-analytics in that regard. They're not walking in with everything's rosy and everything's wonderful. And I think we can really tell that difference. Like, we won't use those in a portfolio. One of the international funds at the moment, higher alpha generating fund, which is what we're getting onto next, I noticed there. Great example or segue there, because we didn't want to start using that till we had the portfolio manager in our office sat and eyeballed. We can read all the great analytics and statistics and get to that. We don't want a million time wasters in our door. They don't even get in our door.
Don't even get in there.
Unless we've got through those filters. But we wanted to sit there, and Josh and myself, they're just one-on-one with them and have that conversation. And when they leave and you're going, wow, it's like, okay, because if they sit there with a glass, the tour of the spreadsheet pack, Josh can just look at me and go, I'm going to eat him alive here. Go, mate, you can throw that thing in the bin.
Yeah.
I can read a brochure.
Yeah.
I didn't need you to turn up to a meeting for me to read a brochure. So tell us how you manage your money, your philosophy, your theme. What are you going to do when markets are up, down?
Yeah.
Tell me a great period you got right, a period you got wrong. If they then have to go and get the brochure, we're probably not for them.
No. And you are, and I think it's fantastic. You are brutal.
We're here managing clients' money.
No, it's spot on. But it's the research that goes in before even these meetings.
Yeah,
and it's just that level of accountability is probably the bit I like.
Oh, correct.
We don't give anyone wriggle room because what we're doing is too important.
Correct.
So, okay, I want to mix it up a little bit to private equity.
Private equity is an interesting one there. Look,
because it is getting quite. There's in our industry, there's a lot of advisors out there, and it's been the flavour of the month.
This is the biggest thing we see high net worth thinking they need access to. You've got to have access to. It is. If you read the stats, it's 1 in 5, or 2 in 7, or 3 in 7 fail of what they invest in. Now that just doesn't sound like a good batting average to me in anything. Why don't we go for something that's boring, consistent, gives us alpha plus a bit more over and over and over, and compounds and do that. So if we want to have risk in our world, we'd use thematics. We wouldn't. Private equity, you put your money in, when do you get it back?
Yeah.
Oh, it'll go for 7 years. Really? What? 7 years? They're just going to sell everything and get it back. How do they liquidate all of these assets in 7 years? Or is 7 years just the time frame that they've all picked? And invariably people don't even know they don't have access to it. Or they'll give liquidity access from time to time. Okay, great. But whenever these have an issue, everyone asks for their money back and nobody's getting it.
Yeah.
So just know what they're doing out there. We've seen in our industry the competitors out there selling out to private equities on ridiculous multiples, buying businesses and buying a relationship with your advisor, as we spoke about one of the others we've done with Brooke there. It's that trusted relationship. Yeah. You can't just buy something and change that, in my opinion, because that's why clients are walking in our door, because we're a legacy business. All the advisors here, they own the business. Nobody's...
That's right.
There is no corporate private equity out here bringing a check in. We're not interested in that. So you just haven't seen it. I haven't seen it work amazingly well of anyone dying to get into it.
Yeah. And I know we don't have this sort of to talk about property trusts.
Property trusts, my issue there is fundamentally how they work hasn't changed for decades. They are a trust. Your money goes in, it's pooled with everyone else's, and if you want an amount back, the bigger you are as an investor, the harder it is to pay that portion out. We had one lady, took her 5 years with a well-known big-name trust. Wasn't an issue with the investments, it's big. when she asked for it back. And every quarter there's only a certain amount of liquidity out there. You know, look at what happened with Centro, one of the biggest ones out there back in the day with the GFC, that you would have thought too big to fail. They owned every shopping centre out there, and in Australia you seem to walk around, they were everywhere, and now they're nowhere. Now they were fundamentally, it was the structure, or the issue was in regards to that. And timing, and there was, you know, they had borrowing and debts and all of these things happening in the background. You've got no control over that. If you want a property, love property, go buy it when you want, go sell it when you want, have control. You want control over that property as to what goes on.
Yep. No, fantastic. Now, just really conscious of time, we've sort of got the three sort of property around commercial property, residential property, off-the-plan property. Do either of you have any sort of comments or thoughts that you think people should just be at least aware of or thinking about if they are, you know, looking at that?
Yeah, just touching on the commercial property, because that's very important for business clients. That is the premise of which you operate. And thinking of a specific client there, really coming down to knowing your terms of your lease contract, how long that you are able to operate out of there, making sure that when it's coming up for renewal, you're conscious of that, to have a conversation both with your advisor and the landlord. And then also as well, one of the big factors is the location. So Troy touched on it earlier around the Gold Coast demand for location. It's put simply, if you're running some sort of labour or services business out of there, you might want easy access to the highway, which in that location there may not be a lot of commercial property. So therefore this can often increase the demand for those businesses. So I think certainly if you're a tenant in there, then to keep out for those things. And then as a landlord, you just want to make sure that the tenant's business inside your property, you at least know the fundamentals of how they operate. We saw through COVID, unfortunately, a lot of those relationships unravel through there. So I would just point out the vacancy and the tenancy is probably the two I would think of.
Yep.
Yeah, and I cheated, so we did a podcast with Paul from Kaloshi.
I know.
So I thought I'd ring him on the land sheet. But in regards, because it's more the off the plan, and he said it's got to be an A-grade location with an A-grade builder with an outlook that's not going to be built out. If you're going to take the risk, make sure it's for the right thing.
Yep.
Too many B-grade builders, B-grade locations out there, something that, you know, they say can't be built out, but the three old houses down the road and it takes the view, you got a problem. So didn't mind his advice on that one. I thought that was a good tip. There's so much we have a look at, particularly the Gold Coast, the amount of cranes, rates are going up, people aren't able to borrow as much, the investors are pulled back from the market, all of those things. I've been around the Gold Coast my whole life, seen those cycles end, they don't end well. Yeah, just be careful. Whereas if you buy your house, your resi, it's sitting there, might be worth as much through the cycle, but way lower risk in holding them through that cycle.
So look, I'm going to leave you the final word with you, Troy, on I guess today's conversation, because as chair of the investment committee, we are conservative by nature.
We are
as a business. Is there anything that you think as a final statement, people listening should be thinking about when they are actually building their portfolios or when they're looking at their portfolio? Yeah,
it's having that philosophy and having it for a reason and having it grounded. So, you know, we did another podcast before, good questions. A lady the other day, well, how do you sleep at night, chair, for over $1 billion of investments? I went, soundly. Yeah. Because I know why every bit of investment is in the portfolio, what it's there to achieve. And, you know, Josh can tell you we'll have plan B, C and D for each of those.
Yes.
And we've got a philosophy and we know what we do. We know we're going to reweight each quarter. We've got more than a decade of that model history, and I've probably got another, 10, 20 years before that. Using an abacus, Josh, there probably to do it back in those days. But to me, the enabler with technology, it's only getting better. So that when we're sitting, look at these, and like this high alpha strategy we identified, we'll sit there going, we're doing a review of international. I want Josh to go and do his research. Yes. I'll do mine, the independent asset consultants, and then get in the room and say, all right, what did you come up with? Upside, downside, international, consistency, size, scale, the parameters.
Yep.
Oh, okay, we can narrow it down to 5. Now let's go digging. But I don't want the guided 2. I want to find the bits and pieces. Who's that portfolio manager? How long's he been around? Who's in the team?
Yes.
All of those, we get down to 1 or 2. All right, let's go meet them. Either we're going there or they're coming to us.
Yep.
When we've done all that, then we'll put it forward for a recommendation.
Yes.
but not until that point.
And every single investment within our portfolio,
same philosophy.
But there's that level of transparency. You can. There's nothing's opaque.
No.
We don't have any structures where you can't get to the bottom of.
We don't want anything
asset.
that can be illiquid. So that's why private equity mortgage funds all fail our filter. I want any client that gets out of bed, has the worst day of their life, diagnosed with cancer, stroke, heart attack, any issue, goes, we need money, we can get it.
Yep.
Never want to have that conversation. And those issues, when it's a market issue and things go bad, all of those things become an issue and people wash it through. Oh, that was the market, that was a downturn. No, I don't want to have that conversation with clients.
Yep. No, fantastic. Hey, look, guys, that was fantastic. Loved it.
I'm sure we went over time.
Oh, I'm sure we did. But I love this sort of conversation because I'm fortunate to sit in this studio now, but also at work. You both love it. You breathe it.
We think this should have gone for another hour.
I know,
absolutely.
Exactly. But I tell you what, Josh, we'll definitely get you back because there's lots more we can talk about with a lot of the areas that you work within the business as well. So thank you for joining us.
There you go. We've been allowed to talk portfolio construction on the next one.
Yeah, no, I think it's good. And as I said, I think I said the first one we had, this was driven by a client who actually wanted us to dive a little bit deeper. And there was just a comment. They said, look, why don't you go into the asset classes? It makes it a bit easier to...
And we'll have that stuff on our website.
We will now.
Yeah,
we will now. Absolutely.
I look at Greg; it's a him problem.
Yeah, that's nice, and that's fair. That's fair. So, if today's episode has sort of raised any questions, please reach out to us at rfsadvice.com. Always happy to talk, and we also have some really good resources on there. So, Josh, thanks again. Troy, always a pleasure.
That was a fun show.
Thank you, and Oliver, great work over there. And until next time, take care.